So you've come around the world, you've met a lot of people,
Yeah.
and the overriding sort of sentiment is towards China is what?
Do nothing.
Okay. Until?
Until more policy clarity or until clear catalyst. So we met with nearly 300 investors in Hong Kong, US, Europe, and Singapore. And every investor, we surveyed them, what's your plan between now to mid-October, the party congress? And globally, generally 50 to 70% of respondents said do nothing. However, for the remaining 40% or so, it was probably 7-1 add to reduce China. So generally people say, valuations are cheap and expectations are low. They do see much more upside than downside. However, many of them said we tried to be bullish on China several times in the past 2 years, always got it wrong, and by now they just feeling so frustrated that they need to see concrete catalyst before they pull the trigger.
And your Wax and Wane, we're showing it right now, basically in the middle, neutral. What does that tell you right now?
Yeah, so for the Wax and Wane, because it's a daily reading, for the past weeks or so, it's back to neutral zone, which means even though liquidity is very abundant and valuations are cheap, but fund flow is not supportive of a short-term rally for now.
How much of the pain is really down to the Fed and others, and not so much the domestic economy? Because we keep looking at the weakness, and certainly there is weakness in the economy, but the money getting sucked out of these markets is really what's happening outside.
Yeah, I mean, strong US dollar typically is bad for emerging market or any risky asset, and RMB could still be under more pressure in the next 6 months or so. However, having said that, I think for China market, domestic factor also plays a bigger role.
Okay.
So for global long-only investors, hedge fund in New York City that we met, they say, if China doesn't reopen, we won't even look at China, right? So reopening is probably the #1 most important thing global investors are looking for China investment or turnaround in the China sentiment.
Oh, wow. Okay, so in terms of catalyst, that's one. What are the other ones you think that are also in that category of most urgent and most needed? Is it the property sector?
Yes, certainly. I think the good thing is for property sector, we've seen the policy turning point happened in July, August, right? After the mortgage boycott, after the very weak credit data in July. So policymakers have become more active in terms of launching these piecemeal policies. But I think this time the government's strategy toward property is different, that they don't want to have a big bang stimulus. Instead, they're trying to do just enough. So they are watching the market, launched a batch of policy, and they hope to see, the transaction activities, the property market, the credit demand to stabilize. And if that's not enough, we'll probably see the next batch of policy easing.
Just to let you know, too, so the onshore renminbi has now weakened past the peak in 2019, and it's now at the weakest level against the dollar since 2008. It's fallen against the dollar. It's also fallen substantially against the Hong Kong dollar. There's a reporting season coming up. What's the material impact going to be? A lot of Chinese companies report in Hong Kong dollars, and that exchange rate has just exploded higher, too.
Yeah, but to be fair, it's not really China's problem. I was looking at some chart this morning. Pound is at the lowest level for 200 years or something like that. So, look at Japanese yen. You can look
35, but yeah, 200 is okay.
Okay.
Who's counting? It's bad.
Yeah, so I think, currently it's the strong dollar rather than RMB proactively try to compete for depreciate. And I don't think that's Chinese regulators' intention. So for now, it's negative for the economy, for the earnings, but we're hoping, the worst of the depreciation pressure will peak out in the next 6 months or so. That, the Fed rate will probably find a ceiling in the next 6 months or so, whereas China's economy will bottom out and the rate could start to pick up. So, starting from second quarter next year, we might see the pressure of RMB depreciation turn around.
Does that help the whole earnings downgrade story too? I mean, how much longer can that continue for the rest of the year?
Yeah, on the earnings front, for third quarter, we actually seeing less pressure for earnings downgrade, right? Beginning of the year, consensus was looking at MSCI China 2022 earning growth to be 14 to 15%, and that's the time we said it's too high. End of March, 11%, end of June, 3%. So second quarter, we saw the most earnings downgrade. But by now, consensus looking at around 0 to 1%. So earning downgrade actually has slowed down in the past quarter, and I would say at around 0, 1%-ish. it's probably quite close to reality. So I think, last time I said it's the last final leg of earnings downgrade. I think earnings is probably quite being more realistic now.
Pick one sector that you think outperforms next year.
Yeah.
For next year, there's a lot of uncertainty depending on whether they reopen, how much a property recovery we're looking at. But for next 3 to 6 months, I think internet sector will probably lead the rally if China does rebound and reopen. In our global investor survey, also around 40% investors chose internet because we've seen reduced policy overhang for the past 6 months or so. We've seen valuation getting to much lower levels, and actually earning revision for the internet sector is positive. In the latest second quarter results season, energy and internet are the only two sectors showing positive earnings surprises.
True. For the Party Congress, is there any way to position around that? Are there certain sectors that are going to benefit, or does the Fed story kind of overshadow all that, you think, this time?
Yeah, in our recent investor survey, basically 30 to 40% people said they have no expectation on the Party Congress. Increasingly, people start to worry that it will become a no event, right? Now, to be fair, Party Congress in itself is supposed to be more for party building rather than the specific economic policies. But given that's such a big political event of the year, investors do have some hope that, the very draconian zero COVID policy could have some relaxation after the Party Congress. And, the focus of the top regulators will be put back to economic growth after the Party Congress. So I think pro-economy policies and relaxation of zero COVID are the two big hopes, not necessarily coming out of the Party Congress, but after the Party Congress.